Hello, my name is Rachel Vahey. I'm a Senior Technical Consultant here at AJ Bell. Today's topic is taking income in retirement. Clients typically have a range of assets to support their cash and income needs in retirement. These include pension plans, ISAs, cash savings, investment funds or shares, business lets, and buy-to-let properties. The order in which people take income from their savings is very important. It's key to think about the order to both reduce the amount of tax people are paying in retirement, as well as making sure that people can pass on death, any unused assets to their family in the most tax efficient way. Now, this webinar is going to discuss this in greater detail. The learning objectives for today are to understand the tax allowances and zero rates of tax which apply, to describe the advantages and disadvantages of how different assets can provide income in retirement, and to discuss which order assets could be taken in order to maximize tax efficiency. So that splits us up into three distinct sections: allowances and zero rates, looking at the assets and the range of assets, and then finally we're going to look at which order the assets can be taken. But before we start, I want to give you some context about the level of wealth in the UK. Now, the statistics from this slide have come from the ONS Total Wealth in Great Britain survey, which was published about 14 months ago. It covers the period April 2016 to March 2018. And you can see that the total household wealth at that point was a massive £14.6 trillion. That's a 13% increase in real terms above the previous 2-year period. And this increase mainly came about because of increases in both pension wealth and property wealth. The median household net wealth is £286,000. But wealth, as you would expect, increases with age. If we're looking at households where the main person is age 65 or over, then 22% of those type of households have wealth of £1 million. Once they reach the tipping point, so to speak, of state retirement age, though, we can see the amount of wealth starts to fall off and starts to decrease. And that is just natural. People are beginning to spend the wealth that they have accumulated to support their living in later life. For older households, net property and pension wealth dominate the total household wealth. And again, that's probably what you would expect. As wealth has increased, the amount of money that people are leaving to the next generations has also increased. If you look over the 10-year period of this slide, and this slide shows the IHT inheritance tax receipts from the HMRC, which were published last July. But you can see that over the last 10 years, there's been a more or less steady increase in the amount of inheritance tax being paid. There has been a dip in the last year in 2019-2020, and this is down to the introduction of the residential nil rate band. Now that was brought in 2017-18, so it was a couple of years ago before that dip in tax receipts. But there is always a lag between the time when the tax arises, which is the date of death, and when HMRC actually receives the inheritance tax monies in. So that explains it. Now, the rising value of residential property accounts for nearly 60% of the £35 billion increase in the value of estates over the past decade. Yet the residential nil rate band is going to start having an effect, I think. It's going to start shifting much of the tax burden onto other assets and properties worth over £1 million. Moving now on to pensions wealth. This slide shows the pensions wealth in Great Britain, and again, it's December 2019 when it was published, and it covers the period April 2016 to March 2018. There's been a steady increase in pension wealth over recent years, And this, together with the introduction of pension freedoms, which has given people so many more options and flexibilities about how they want to spend their pension wealth. On the right-hand side of the slide, I've just put down what the FCA's latest figures are for people who first access their defined contribution pension plan. What do they do with that money? And this covers a period of October 2019 to March 2020. To be fair, there's not been that much change between the pattern of how many people are cashing in their pensions to start off with and what they're doing with their pensions. But you can see that the most popular option is to fully withdraw the amount of money, to fully withdraw the pension plan. But that applies mainly to those people who have got small pension plans, mainly under £50,000. So it is a specific part of the market. Those people who have got much greater wealth within their pension plan, those are the people who are going into income drawdown. If you could compare to buying an annuity, there are far fewer people now taking that option and buying an annuity. Certainly when they first access the plan, maybe they'll start buying an annuity later on in life. So that's a little bit of context. It's important to understand how income from assets are taxed and how assets that are gifted in life and on death or passed on death are taxed as well. And this is going to help the decision of prioritising which savings are used up first, and it will hopefully help you and your clients to devise financial retirement strategies. There is many allowances available for advisors and their clients to use nowadays. We have the personal savings allowance, the dividend tax allowance, the personal allowance, and the capital gains tax-free allowance. And that provides a lot of scope to earn income and to realise gains without being taxed. So there are a lot of levers available for you to push and to pull to help your clients devise the most tax-efficient solutions. So let's have a look at these allowances and 0% rates in a little bit more detail. The first one is personal allowance, which covers the amount of income people can receive before they have to start paying tax. Now that's 12,500 in this tax year. It's been going up fairly, well, I was going to say steadily, but maybe not steadily, but it's gone up quite a bit in the last 5-10 years. Next tax year, the one starting in April, it's expected to increase to £12,570. Married couples can transfer up to 10% of their personal allowance, which is £1,250, to their spouse or their civil partner. Now that's as long as both people in the couple are paying tax, aren't paying tax at the higher rate. So if they're both basic rate taxpayers or don't pay tax. For your clients who are accumulating their wealth, this isn't probably an area of interest. But in retirement, where you would probably want both of them to be basic rate taxpayers, then I think that comes into play as it could potentially save up to £250 in tax. Now, I know that's not an awful lot of money, but every little helps, and it's certainly worth considering. Personal allowance that gets cut by £1 for every £2 of adjusted net income over £100,000 until the personal allowance is completely lost at £125,000 or more. I'm sure you're very familiar with that concept and that you understand the effective 60% tax rate that this has brought around for many people. Total taxable income includes full chargeable gains from offshore and onshore bonds. Just note that it's not the top sliced amounts. Let's move on to the savings starting 0% rate. Now this £5,000 starting rate band is really valuable. Savings income which falls within this band is taxable at 0%. It covers interest such as deposit accounts, gifts, corporate bonds, fixed interest mutual funds, or the interest element of a purchase life annuity. And it also covers offshore bond gains. But it cannot be used for dividends. However, It's lost on a pound for pound basis if non-savings income like pay or pensions or rent exceeds the personal allowance. So I think many people who are receiving an income lose out on this and maybe don't get to realise its full potential. So someone earning £15,000 will find that their starting rate band for savings is cut to £2,500. And where non-savings income reaches £17,500, then the band is completely lost. Let's move on to the personal savings allowance. Now, this was introduced in 2016, and it includes interest and offshore bond gains, but not dividends. Taxation of dividends, it comes under the dividend allowance. The personal savings allowance is set at £1,000 for basic rate taxpayers, £500 for higher rate taxpayers, and it just falls away completely if you are an additional rate taxpayer. Again, it's a very useful allowance and can certainly give a little easement to taxation. The dividend allowance and the way that we tax dividends has changed quite considerably over the last few years. The dividend allowance is now £2,000, and that was set in 2020-21 tax year. It was set in 2018, but it's now 2021. It's £2,000, and I probably can't see that increasing in the future, in the near future. Anything over that amount is at the tax rates 7.5, 32.5 or 38.1, depending on whether it's basic, higher rate or additional rate. Finally, the capital gains tax-free allowance is £12,300. And this is the amount of money that somebody can take in gains and not pay any tax. Now, this is another allowance that usually increases every year. So we will have to see whether it's going to be increased in this budget and in April. It cannot be carried forward. So if you don't use it in any one particular year, you lose it. It's not like the pension annual allowance, which can be carried forward. For the capital gains tax-free allowance, if you don't use it, you lose it. Another important element when you're thinking about these allowances and starting rates is the order of taxation. And I'm just going to touch on this because it is significant as it can affect the availability of certain tax-free allowances and the rates of tax that somebody could pay. So the order is non-savings income first, salary, self-employed profits, pension income, rent, trust income. The second level is savings income, which is interest from deposits, gilts, corporate bonds, fixed interest mutual funds, and also offshore bond gains. The third layer is dividend income. The third order is dividend income, and the last is onshore life policy gains. So it's important to understand this particular order of taxation. So now we've discussed the allowances and the 0% starting rates that apply. Let's have a look at the assets themselves and how they could be taxed. Let's start with pensions and with pensions income. Now, up to 25% of the amount of pensions crystallised can be taken tax-free, and this is the tax-free cash or the pension commencement lump sum. The remainder, the other 75%, has to be taxed as income. Now, people have a lot of flexibility to choose how much pension they want to take. So they could decide to crystallise the whole of their pension fund and then take the full tax-free cash amount and then leave the rest in drawdown. And then they can gradually draw out as much taxed income as they want. And they could do that to fit in with their personal allowance and also their needs in retirement. Or they could decide to take out all their taxable income in one go, or to take a sizable chunk of it. But if they do that, then they just need to be careful about taking too large an amount, because that's going to push them into a higher tax bracket, and it means unnecessarily paying more tax. Instead of crystallizing in full and taking all the tax-free cash, people also have the option to phase in their pension and instead just take a chunk at a time. 25% of each chunk is tax-free, the rest will be taxed at income. And again, they can put that remainder into drawdown and maybe take it at a later date, or to take a smaller amount if they wanted to do so, to fit in again with personal allowances. People can also take chunks of money as UF+, which is uncrystallized funds pension lump sums. And that just means taking a chunk of the money or the whole of the money, and 25% of it is tax-free and 75% of it is taxed as income. So all of this flexibility means that people can set the right level of income to take from their pension. And they can do that as either tax-free or taxable, or a mixture of both. And they can fit it in with the allowances that they have available, and so they can minimize the tax that they will pay. Just one word of warning, they need to double check that the pension scheme rules to make sure that this flexibility is allowed. For some of the older pension schemes, it may not be allowed, so just double check and transfer to a newer type of pension contract if necessary. Going to move now on to death benefits within pensions. Any pension left over when the member dies can be passed on to their beneficiaries. Now, members have incredible flexibility to nominate who receives this pension money. They don't have to leave it to their spouse or civil partner. They could leave it to their children or their grandchildren. They can really nominate anyone they want. They could nominate the postman if they wanted to. It is allowed. Just a word of warning on this. What you are doing is you are nominating who is going to receive your pension money, but it's up to the scheme administrator to actually make the distribution and to actually make the decision about who receives it. So to keep the nomination forms updated, and if it's going to be someone slightly unusual, which is probably not reflected in the will, then maybe to give a little bit of context to the scheme administrator about why you have chosen that particular person. For the taxation of death benefits from a pension, if the member is younger than 75 when they die, then the beneficiary can take the money either all at once as a lump sum, or gradually as income, or not touch it at all. But if they do take an income or take it all as a lump sum, then they have to pay income, then there is no income tax to pay. So no income tax, it's tax-free if they die before age 75. If they die after age 75, then it is taxed, and there will be income tax due on the amount of money that the beneficiary will take from the pension. Now, the majority of people do die after age 75, so it's worth thinking about. It's also worth thinking about what happens if someone comes up to the age of 75 as well. You could have somebody who decides to leave their money to their higher rate tax paying children, for example, and they say, well, I'm just going to pass my pension money on to them. But when they get over 75 and the money is going to be taxed, and the pension money is going to be taxed when it's withdrawn, they may decide to miss out that generation and skip a generation and just leave it to the grandchildren, who are more likely to be lower taxpayers, lower taxpayer rates. So, or not paying any tax at all. So maybe when they get up to age 75, they could review their options. The other big significant point is that pension money sits outside the estate when you look at inheritance tax, and therefore inheritance tax isn't usually charged on pension assets. Now, again, that word usually is quite weighted. It's always weighted in pensions, and there are going to be certain situations when IHT is going to be due. But these are usually where the member has directed how the money is to be passed on, not nominated, but directed how the money is going to be passed on. Also, IHT could come into play if the member is in serious ill health and transfers within 2 years of death. Now, this is a really complicated subject. We have an excellent webinar on it, though, so if you may want to go and have a look at that just to find out a little bit more information. The bottom line with all of this, though, is because the way that death benefits under pensions work now, it's probably worth considering not using the pensions to provide income, even though they are super flexible. Instead, your clients might want to use them for inheritance tax purposes because they do sit outside the estate. If that's the case, then accessing the pensions goes to the bottom of the order list, and it's the last thing that people do is to access that particular money. But as with everything, this depends completely upon the client's circumstances, whether they need income, what the other available allowances are, and also the lifetime allowance might also come into play here as well. Let's move on to ISAs. Now, money taken from ISAs is going to be tax-free, but it's worth remembering that you are taking it out of a tax-efficient, a tax-free environment. They're very flexible. It's easy to get hold of your ISA money. You can take it whenever you need it. There's no income limits. You can take all of it or some of it. The only thing to be aware of is if the money is invested in a lifetime ISA, a LISA, then if you take the money out before the age of 60, unless it's to buy a first property, a first home, then there will be a charge, a penalty. And this penalty is currently 20%. But it's due to rise and due to go back up to 25% from April this year. But because the money from an ISA is tax-free, you're not using any of your allowances if you use it for income. You're not using up your personal allowance or your savings allowance. So it's not really efficient to use the ISA as the sole income. Instead, clients may want to combine with other incomes that do use up these allowances, and the ISA income can be a sort of a top-up if required. If the ISA is not spent, it will usually be left in the estate and be subject to inheritance tax. The amount of there is another element around this, and that's if you leave a spouse or a civil partner, then they can claim the value of the ISA as an additional subscription to boost their £20,000 beyond, to pay in more than £20,000. And if that's the case, then the ISA usually comes back to the estate and then can be paid out to the spouse to use it. The client could take the funds out of an ISA and place within a inheritance tax trust, or they could take the money out of the ISA and gift it in life using inheritance tax allowances or out of normal expenditure, and they could do that. And again, this just needs to be really thought through because you are removing it from a tax efficient environment. The client could also invest in AIM shares that qualify for business property relief within ISAs. Now, if they do this, the capital will fall out of the estate for IHT if it's held for more than 2 years. But there are significant downsides in terms of risk, and this is not a solution that is going to be suitable for everybody. In addition, the Office of Tax Simplification did a report on IHT and how to simplify IHT a couple of years ago. And in their report, they flagged this as an area where these sort of types of scheme as an area where the Treasury may want to clamp down on in future. So again, it may not have longevity, these particular types of plans. It really just depends how the Treasury reforms inheritance tax, if they do indeed reform inheritance tax. Collectives, gains on collectives are subject to capital gains tax, so clients should plan to minimise capital gains tax on disposal, and to do this they could use their capital gains tax-free allowance. They've also got, which is 12,300, and again, just to emphasise, to use it within a particular year or you lose that particular allowance. There's dividends allowance as well of £2,000, which we have been through before. It's quite a big jump in tax, the amount of tax you pay for dividends. If you're a basic rate taxpayer, then it's 7.5, and that jumps to 32.5 for higher rate. So it's almost worth trying to get somebody into the basic rate taxpayer to reduce this tax implication. Again, you could place into trust for inheritance tax purposes. For investors who have unwrapped taxable portfolios, then maybe spending these first makes sense, more sense maybe than spending ISA funds with their tax advantages or taking pensions or taking income from pension plans. So maybe these sort of investments are the ones which are more to the top of the list. Finally, investment bonds. Again, the client has quite a degree of flexibility about what they take. They can minimize tax on chargeable gains. They get 5% tax deferred withdrawal each year. Onshore bonds are taxed as income only if they fall into higher rate band. And offshore bond gains are taxed as savings income, but they're able to use the savings allowances to offset the amount of tax paid. Again, you could place it within an inheritance tax trust. You plan to minimize income tax on chargeable and plan to minimize tax on your chargeable gains. Investment bonds could also be assigned to somebody else without it triggering a chargeable event, as long as cash doesn't exchange hands. So this means if your client is a higher rate or an additional rate taxpayer, then they could assign the bond to a spouse or to a partner without triggering a tax charge. And this is going to be especially useful if they're a basic rate taxpayer or a non-earner. That's if the spouse or civil partner is a basic rate taxpayer or non-earner. Any withdrawals are paid to the new policy owner, and they can also they can make use of the 5%, any unused 5% allowances to defer the tax payable. Moving on to property, really looking at residential property, but also buy-to-let property. And you could obviously, when you come up to retirement and you want to realise the money, you can sell the property to provide you income or to gift it, or you could gift the whole property to your family. When you come to sell it, it could be difficult to realise it's an illiquid asset, and the property markets don't always play ball. So selling your property might just not be the right time. It really just depends. If it's a buy-to-let property, then there's going to be a higher capital gains tax to pay. Another option could be equity release, and that could provide a tax-free income. And that might be useful and might be worth thinking about if the client has used up all their other allowances, but they still need some income. But the clients and their family really need to think through this very carefully. They need to be aware of the implications for the family, and also if there are high interest rates at the time that they take out this particular plan. But property is another way of providing income. Now, I'm not going to spend a lot of time on this. If you are looking to minimize inheritance tax, there are various ways that you can place these assets or some of these assets into trusts. And what I would just say is it's about picking the right type of trust to suit the circumstances. So it's looking at who the beneficiary is and whether it's a named beneficiary or whether it's a discretionary class of beneficiaries. So for example, just grandchildren. And it's not always about inheritance tax and minimizing inheritance tax. Setting up the right trust is about giving the settlor the control in life. It's about control. What do they want to do with the money? Do they want to pass the asset over completely? Do they want to just pass the income over? It's about the size of payment, and it's about getting the money to the right person at the right time. You need to think about the cost of establishing and running the trust, because this could be a deciding factor about which trust to pick. Also think about gifts and exemptions and how to minimize inheritance tax without necessarily going down the trust route. So there are lots of things to think about within trusts and which trust to set up. So now we've been through, looked at the assets, and we've looked a little bit at taxation. Let's consider what order you could take the assets in. Now, deciding how to take income in retirement is a really complicated thing. It's probably, I think it's a lot more complex than how you build up the wealth. You need to really know your client. You need to understand what their needs are, what their priorities are, what their objectives are. I think it's also psychologically hard to shift from being a saver to a spender, and to say, well, okay, I am going to crack open that particular asset and take my money out. One of the things that you could find is you're having conversations with your clients about leaving pensions alone and cracking open other assets to give an income stream. And I think psychologically that's hard to get over. The word pension is, goes back hundreds and hundreds and probably thousands of years to the Romans. This is an annuity. This is about giving people a steady income. So people think that's what a pension is there to do. And I think that has shifted over the last few years. So to try and get your clients' minds around this shift as well could be a little bit tricky. Some of the things you're going to have to think about within this complex decision is setting up an income, and really whether that income is to last a lifetime or to last a certain point. And obviously cash flow modeling and looking at all of those particular tools is going to be so valuable here. It's also looking at tax efficient solutions, how to use tax deferral, tax exempt assets, how to use all your allowances and zero rates of tax. These sort of clients have limited opportunity to rebuild wealth. So it's all about control and just sustainability. There's a lot talked about the retirement income smile. So you start off taking your income money and it's quite high, and then as time goes on and you lead a more housebound life, then it falls, but then could possibly rise again towards the later years of life to cover healthcare. So there's a lot spoken about that. Whether it's true or an urban myth is maybe another thing, but it's obviously a conversation you need to have with your clients and how they are going to cover any healthcare costs. One other angle which comes into it is how the assets they have mesh, and what the implications are when you're calculating how much this healthcare is going to cost. And so just be aware of the deliberate deprivation rules as well around that. Your clients are probably going to have a property. So how do you use that property? If it's a buy-to-let property, but also the main residential property, can you tap into the wealth which is held there? Do they want to do that? Do they want to downsize? And downsizing always sounds magical, but trying to find a bungalow in precisely the right location you want may be a little bit more tricky. Or do they want to think about equity release plans? But as I said before, that may be quite a complicated conversation to have with all of the family. It's also about managing risk and how your clients feel about managing risk. The days when retirement was supposed to last 15 years are long, long gone. We're talking about a 30, 40-year time span now. So it's really, how do clients manage this risk, especially where they have no control over things like investment returns or inflation. And obviously one of the added complications is longevity. Longevity is not a complication. Let me just emphasize that. It's a good thing. So, but it's trying to devise a plan for the whole of the lifespan of the person. So you could look at all these calculators and figure out your probability is you're going to die at 86 or something like that. But that's usually just a median figure. And so when you're building in plans, how far do you extend them? Do you extend them to 100 years or 110 years? And again, that will depend upon the client and their family circumstances and their personal health. And also helping the next generation. Do you want to pass on assets now when they absolutely need it? Do you want to save it to when you're gone? Do you want to use these assets beforehand? All of those particular elements go in. Now, each client is the plan you put together for each client is going to be different because every client is different. So it's just going to depend upon personal circumstances, how much level of income they need, how much money they have, or what sort of assets they have. Do they want to leave it to what's the balance between the assets that they want to live on now and the ones that they want to leave to the next generation? And different people have different views about that completely. You got to think about the general health position, the cognitive capacity as well, and whether you want to set up something that is really complicated when they get into later life, or whether you want to also change your plans to simplify it. Appetite for risk, obviously, and just as a hygiene tick factor, you will be I'm sure that you will be covering wills and powers of attorney and just making sure these are up to date and in place, as the nomination form for any pensions as well should be. Now, because it's so dependent upon the client, there are so many orders that the assets could be taken. But I'm going to show you here is one possible order. I would probably emphasize that it really depends upon the circumstances of the individual client. But what you could do and what the client could do is to first take any investments that are held outside ISAs or tax efficient wrappers. So they're looking at shares and bonds and buy-to-let properties, all of which could be subject to capital gains tax or inheritance tax. And these could be tapped gradually. So you take out a little bit and just working with the allowances that you have. Investment and cash ISAs, probably the next things to probably start to take an income from. With the exception of those held in an AIM portfolio that is going to qualify for business property relief, and we covered that earlier. Homes, if they push the estate over 2 million, and so they reduce the power of the residential nil rate band, people might want to consider downsizing and spending or gifting the money that this frees up. And then investments with BPR status, which are going to be shielded from inheritance tax if they're held for at least 2 years. And drawdown pension plans, maybe the last thing to come in because they are so good for inheritance tax. But do remember they are incredibly good at providing flexibility for income and therefore using the allowances that people have. So let's try and wrap all of that up and put it into an example. Now, I've included a case study. It's a simplified case study, and I would emphasize that this is very simplified, but it's to demonstrate the principles involved. Okay, my case study is David. He is age 60. He has a SIP worth $1 million, ISAs worth 300,000. He has an offshore bond, and he's taking a 5% withdrawal each year. He has a portfolio of equity investments which are paying £10,000 dividend, and he wants an income of £75,000. The traditional approach is probably take your dividend income and your bond withdrawal, because that's what you're getting at the moment, and then just use your pension to top up to your required level. And you don't have to take all the pension, you can phase it to use tax-free cash and taxable income to get the best solution. So we put those principles into practice, then we have, let's say for this particular case, we're going to take 64,300. We're going to crystallize that amount of money. 25% of that is tax-free cash, so that's the amount which is paid out. The next amount of money is the taxable pension. That is the 75% which is remaining on the amount you crystallize, 48,000. The personal allowance comes into play here. The rest of the money falls within the basic rate of tax. So that reduces to £41,080. The next is the dividends. That's £10,000. £2,000 of that is tax-free allowance. Some of it is taking up the remainder of the basic rate tax band at £1,775, but the other part of the £8,000 is going to be taxed at the higher rate of 32.5. Also got the bond, which has been tax deferred, and that's a 5% withdrawal, and that works out at 10,000. So that gives the total income that David was after. That gives the £75,000, and the tax paid on that is £9,300. So that's the traditional route through. An alternative is that he uses his tax deferred withdrawals from the bond, But he also makes more use of his personal allowance, his personal savings allowance, and his savings rate of 0% against any offshore tax gain. He could realise any equities to use up his capital gains tax-free allowance as well, because he hasn't used that in the previous example. He could take some of his ISA income, that's tax-free, and again, he didn't touch that before, so that might be a solution. He could consider equity release because it's also tax-free, but as we've discussed before, that's maybe not a simple, straightforward decision and needs to be gone into. He could just take his tax-free cash from his pension and leave the rest in drawdown. So we could do that as well. Now, if he leaves his money in drawdown and he doesn't take any out, he could cascade the money down to the next generation or the generation beyond that in a fairly free, IHT-free way. But I would just say with this particular case, David has £1 million in his SIPP, so he might want to be aware of the age 75 lifetime allowance test and the fact that he might have to go through that, and he might be due a lifetime allowance charge. Now, I haven't gone into all of that because just for the sake of simplicity, but it is a particular consideration that you would have to just work through. Okay, so I'm going to go through this and see how this comes out. I've made no assumption for advisor charging on the bonds, and again, I'm just going to say that just to make it a simpler, easy discussion. So David could, this is a suggestion, he could take £28,500 from his offshore bond. Now, £10,000 of that is his regular amount and is his tax deferred amount. The rest of it, the £18,500, he can offset against his different allowances. So his personal allowance, his personal savings allowance, and his 0% starting rate, tax starting rate. So by using all those three different allowances, he can take out £28,500 and not pay any tax. His dividends are, again, £2,000 of it tax-free, but he could look at, he will be charged on the £8,000, but it all falls within the 8 basic rate bracket, so reduced amount of tax he's paying on his dividends. He could realise some of his equities and realise up to £12,300, and that falls within his tax-free allowance for capital gains tax. So again, he might want to think about doing that. Now, I've included a slice here of pension money, and I've included pension tax-free cash and said that he's crystallised 60,000 and he's realised 15, and the other 45,000 has gone into his into drawdown. And I've done that because he had quite a high amount. So he may want to do that, just as I said before, just to sort of to avoid another lifetime, not another, but to avoid a lifetime allowance tax charge at age 75. But that really needs to be explored in quite a lot of detail about his life expectancy, his health conditions, and to really work through the numbers to see how that works out on paper, to see if it's really better. It could also be better just to take the hit and just to pay the lifetime allowance tax charge. It really just depends. So it's worth exploring that in a lot more detail. I've also used a top up from his ISA and used £9,800. So that gives me, when you add it all up together, a total income of £75,000, and the amount of tax that he's paying on that is £600, so considerably less amount. So hopefully that case study has helped you see how these principles could work in practice. I really hope you've enjoyed today's webinar. We've been through the tax allowances and the 0% starting rates for tax. We discussed the advantages and disadvantages of how different assets can provide income in retirement. We've looked and discussed about which order assets could be taken in retirement to provide an income to maximise tax efficiency. I hope you found it helpful. If you do have any questions, then please get in touch. Thank you very much for your time.